Okay, let's move on to the second topic, the challenge of regulating international banking. So far I explained the domestic banks, the safeguards for the domestic bank. But how about international banking safety? How about, is there any safeguards for international banking system? So let's check that. So first, deposit insurance. In the international banking, deposit insurance there is no deposit insurance basically. So basically, deposit insurance is non-existent. There is also the national deposit insurance, but the national deposit insurance system protects home and foreign depositors, of course, but there is so small and does not protect large sources of funds such as interbank deposit. So the national deposit insurance can be used, but very limited. Deposit reserve system also basically non-existence. So there is no deposit reserve system in the international banking. Capital requirements, asset regulations, and bank inspections are difficult in an internal environment. So, for example, bank inspections typically monitor balance sheets of home banks and foreign branches on a consolidated basis. Inspections of records of foreign subsidiaries and subsidiaries and affiliates are not strict. So there is ambiguous and no regulation as to which countries are to be inspected and regulated. So there is uncertainty, unclear regulation, so monitor system in the international banking. There is unclear monitor system in the international banking. In the international banking, so who monitors the bank is unclear in the international environment. So there is ambiguity and no regulation as to which countries are to be inspected and regulated. Okay, so the same discussion can be applied in the lender of the last resort. So which central bank has responsibility to the lender of the last resort is not clear. So therefore, central bank do not want to conduct the lender of the last resort in the international banking because the responsibility is not clear. Bailouts and restructuring. So speaking about bailouts and restructuring, when a bank has assets and liabilities in multiple countries, the government responsible for bailouts and restructuring is also in multiple countries. So therefore, there is ambiguity in responsibilities. So the concerns about delays, so it becomes a concern about delays and impediments to activities. Okay, so in the international banking, there is unclear responsibility. So the responsibility of the last lender of the resort or inspections or bailouts are unclear. So therefore, the enforcement is not, so the activities cannot be forced, or so the safety system is not forced. Okay. So let's introduce the financial trilemma. Do you remember another trilemma? learned so far, okay? The trilemma we reviewed so far is, I guess, the international finance trilemma or monetary trilemma. Okay, so the trilemma we learned so far was the monetary trilemma. Today we introduce the financial trilemma. So these two trilemma are different. The financial trilemma is that up to two of the following three are feasible. First one is financial stability. Second one is state control of financial security policies. And third one is freedom of international capital movement. So if we take financial stability and state control of financial security policies, then we need to give up freedom of international movement. If we take state of control of financial security policies and freedom of international capital movement, then we need to give up financial stability. The last one is that if we take financial stability and freedom of international capital movement, then we need to give up the state control of financial security policies. Okay, this is the financial trilemma. Okay, let's review the international collaboration on regulations until the global financial crisis, In the 1974, Basel Committee was established. The Basel Committee's objective is to place greater emphasis on the supervision exercised by national authorities over the international banking system. So this is a Basel Committee established by the central bank governors of 11 industrialized countries. In 1795, 1975, Basel Committee Agreement on Concordat. So Basel Committee agreed, and that contract is called Concordat. Concordat is the location of responsibility for supervision of banks across host and home countries of overseas branches. So Concordat makes the responsibility clear for all countries. So it requires information sharing and inspections by host country authorities. In 1988, Basel Committee promises minimal required bank capital levels, and this is called Basel I. So this is called Basel I. So generally, the required levels is 8% of assets. Also, Basel I indicated how to calculate that capital ratio. In 2004, Basel Committee updates the Basel I guidelines to Basel II. So now Basel version is Basel III, I guess. So notable point around the world is growing importance of emerging market countries. Emerging markets are the capital markets in newly industrializing countries that have liberalized their financial systems and allowed at least some private asset transactions with foreigners, like Brazil, Mexico, Indonesia, and Thailand, etc. Such emerging markets are an environment that tends to create moral hazard due to looser standards of accounting than in developed countries. So the regulation or standards are looser. Standards of accounting are looser in emerging markets, and that looser standards create the moral hazard environment. So to prevent such moral hazard, in September 1997, the Basel Committee issued basic principles for efficient banking supervision to extend the best internationally accepted regulatory standards to emerging market countries. Okay, so Basel Committee focused on the possibility of emerging market banking crisis, and then to prevent such the crisis, the Basel Committee issued basic principles for efficient banking supervision. Okay. Oh, sorry, I forget to write takeaways. Okay, so I write takeaways and they upload the Google slide, Google Classroom. Okay, but today we covered the international banking system, the regulations about international bank. There is possibility of bank failure or the bank run. So the doubts about doubts of depositors doubts of depositors causes bank run, can causes bank run. So even if the bank is healthy. So such the chain of bank runs causes systemic banking crisis. So we reviewed the bank's balance sheet and check the risk of the bank. So that is term mismatch. Also, high capital ratio make banks safer, and it's need to, so in the last part of the lecture, we introduced the Basel 1. So in the Basel 1 or Basel 2 or Basel 3, it requires a minimum capital ratio. Okay, there are several safeguards against financial instability like bank runs. Deposit insurance, deposit reserve requirements, capital requirements, and asset regulations, bank inspections, lender of the last resort, government restructuring, and bailout. Okay. So, moral hazard, it's a very, very important thing. So, moral hazard is a potential for failure to take precautions to prevent accidents because of insurance. So bank supervision and balance sheet restrictions are necessary to limit moral hazard created by deposit insurance and access to the lender of the last resort. So there also we reviewed too big to fall problem. So too big to fall institutions tends to be moral hazard. Okay. So in the international banking, so there is basically no safeguard to prevent bike failure. So deposit insurance, basically there is no deposit insurance, deposit reserve system, and capital requirement and asset regulations are limited because the responsibility is unclear. Also, the lender of the last resort is also limited because central bank responsibility is not clear. Bailout and restructuring also faces unclear responsibilities. Okay, so we will do the financial trilemma. So there are three concepts, but only up to two of the following three are feasible. Okay, we learned international collaboration on regulations. Before the global financial crisis, we introduced the Basel Committee at the Basel 1, 2, 3, 1 and 2, okay? So that there is a growing importance of emerging market crisis. Okay, so this is the end of the lecture. So thank you for listening. I hope you enjoyed today's lecture as well. See you later. Bye.